Hey everybody, Economic Ninja here. I hope you're doing great. We're going to talk about the Fed's housing bubble, and we're going to talk about how a handful of companies have now lost their Fortune 500 status. It's interesting when people think of big companies, they think they're always going to be big. If they're big yesterday and they're big today, they're going to be big tomorrow. But if 2008 taught us anything as investors and just as normal people, that things aren't always what they seem, and tomorrow can be a very different day. So this is out of Fortune 500 magazine, and it is entitled "The Fed's Man-Made Housing Market Recession Hit So Hard That Four Real Estate Titans Just Lost Their Fortune 500 Status." Now, let me stop right there and explain something that's very, very important, and people need to understand this. This article is saying how the Fed's man-made housing market recession hit hard. I want people to understand the only reason that home prices exploded in the last 3 years was because the Fed dropped rates not even from ultra low to even below that, to historical lows. So they blew this up, okay? If we were on a gold standard and we can only print so much money, as much, whatever standard it's on, a 1 to 10 ratio, a 1 to 100 ratio, a 1 ounce coin to, $1 billion, right? My point being is that if there was a limit, there would only be a limit to inflation because there would only be so much currency sloshing around in the market, allowing it to go to and fro, whichever way, and cause prices to rise or drop. But because we have no standard, we have no holding back the government and the Federal Reserve, they can print money excessively and they can raise rates as high as they want. They can bring them as low as they want. As a matter of fact, we've even seen, for the first time in history, about 3-4 years ago, negative interest rates in the world, okay? This has by far been the greatest currency experiment in history. And I want people to understand that. It's very, very important that people understand that. Now, let's do this. Let's talk about this story. Oh, and by the way, guys, I'm going to put a link in the description and in the pinned comments to the real estate crash course. It teaches you how to identify these easy points to know where you are in the housing bubble, or to know when you're at the bottom. It is very easy. I went through this back in 2006. I'll put a 70% off link down below, and that brings it to like $300 for the course. And there's 28 lessons, and I'm putting some more on. I'm gonna be filming some more, I think, in the next couple weeks. Actually, about 3 weeks. All right, here we go. It says, not only did rock bottom interest rates during the pandemic spur a refinancing bonanza, but with the help of remote work and tight inventory, they also heated up the housing market in a way that hadn't been seen since the bubble borrowers simply couldn't pass up on a 30-year fixed mortgage with a rate of 3%, or in some cases, 2%. Few companies, of course, benefited more from the housing boom than rocket companies, which during the roughest part of the lockdowns did $5 billion in sales in the second quarter of 2020, compared to the $1.6 billion in the same quarter of 2029. Let me stop there too and say, like Rocket Mortgage right now just came out with a new product. And the reason why they came out with it is because they can't find enough borrowers to borrow money, right? And the only way they make money is by borrowing money. So they came out and said, hey, you know what? Instead of the normal 3% loan, why don't we do this? Why don't we give you, a 3% down payment? Since you can't come up with 3%, no one can come up with 3%, it seems like, because homes are so darn expensive, and we're only looking for the dumb money, right? Sophisticated investors and homeowners that have been homeowners for a long time are watching what's going on and going, no, this isn't right. I'm not going to go in and borrow a bunch of money at these high rates. They go, hey, you know what? Instead of 3%, why don't you just come in with 1% and we'll make up the other 2%. Now, I want people to understand that they're getting their money on the back end. Trust me, they're going to get it in exorbitant fees, or even if they don't charge you high fees for that loan, they're going to tack on just a little bit more interest rate. And the reason why is they know in this raising environment that you are not going to be able to refinance. So they are more than likely going to be able to hold on to that, and they may or may not, I haven't checked, have a clause in there when you can refi or when you can't, because they're going to want to make sure they get their money. And this is a lot of risk for you to only put down 3%, let alone, or 1%, let alone 3%, one of those things. They know they're taking a lot of risk. When you look at housing markets like Austin, San Francisco, Los Angeles, all these places around the country that are falling, Boise, Idaho, they're falling rapidly right now because the bubble is burst, right? We're in the first inning. We haven't hit the panic phase yet, and that's why I'm trying to prepare people for that. But they're taking on risks, so they're going to get their money somewhere. So they're either going to charge you in fees or they're going to charge you higher rates. It says here, that's behind us now, though. The mortgage rate shock created by the Federal Reserve rate hiking campaign has set off a housing market recession. While national home prices remain fairly stable, housing activity hasn't been so lucky. Residential fixed investment, otherwise known as housing GDP, has fallen for 4 straight quarters, while mortgage refinance applications and mortgage purchase applications are down 45% and 31% respectively on a year-over-year basis. The Fed's man-made housing market downturn has been so sharp that when the Fortune 500 list was unveiled on Monday, it was missing 4 major real estate companies, which had been on the list last year. This includes the Rocket companies, which was number 282 on the Fortune 500 list. That's a big deal. To go from 282 to 501 or more, that's a big jump. So it says here, unveiled in June 2022, Zillow was another one. That was 424, so that was an easy bump, right? And then Anywhere Real Estate and Compass. So you think about it, as these companies are falling, and they are falling rapidly in valuation because all the investors are bailing out, they're going to have a harder time getting investor money. They're going to have a harder time raising capital to be able to loan that money out. And then again, they're having to offer these low rates because they're trying so hard to compete with these other mortgage companies when all these other mortgage companies are failing. That is the most important part. People need to realize that. It says Rocket Companies, the parent of Rocket Mortgage, has clearly taken out the biggest hit. The 4 real estate titans that dropped off the Fortune 500 list of the 500 biggest publicly traded U.S. companies over the past year, Rocket Companies' revenue has fallen 54% compared to a negative 24% at Zillow Companies, 6% at Compass, and 14% at Anywhere Real Estate. So Rocket is in a ton of pain. So now you can see why they're offering, hey, don't come in with 3%. You can only put down 1%. This is where it gets really dangerous. You know, another thing I want to talk about is the military. The military men and women that serve our country, they walk into loans, which I love the program. They walk into a government-backed loan program, the VA loan program, with 0% down. And that gets even more dangerous. It's incredible for entrepreneurs in the military that want to buy rentals and stuff and buy VA repos. That's a really big deal. But think about it. You're coming in with 0. You're stationed at a place for a certain amount of time, and then you get transferred, and you may be intended to sell it for a profit or rent it. And if you can't maintain that and you dip into negative equity really quick, it can really mess with your mind. I know what that's like. I knew a lot of servicemen and women that were buying homes on VA loans programs. Back in 2005, 2006, they found themselves trapped in negative equity, and they had to bail. They lost everything, including their credit score. And I think that's something you really need to watch out for. But guys, the fact of the matter is, it's very easy to identify these trends and identify where you are in this bubble. And that's why I put out that course. If you guys want to take a look at it, 70% off right now. I'm going to be putting some more lessons on. I think there's 28 right now. But then you guys can get the sense of where we are and get motivated for all of the opportunities that are coming. All right, guys, that being said, I thank you so much for watching. The Economic Ninja is out.